Mr. Evans here. This video is going to look at long-term sources of finance for businesses. Should be the last video in this finance unit. So it's just going to cover these final four sources of finance that are all long-term sources of finance. So just a reminder that long-term sources of finance are sources of finance that are usually used to do that. They're going to be used for capital expenditure on things that are going to be used to keep earning money for the business in the long run, like a new factory building, or machinery, or buying another company, something like that. That's a big source of finance and is going to be used for the long-term benefit of the business. So there's a few that you need to understand. The first is retained profit, and basically retained profits are it's just like money that you maybe have saved pocket money from last month. If you put some pocket money away last month, or some of your earnings, your wages away last month, that was your retained profit from last month, and you've got it away, and it's your own money. This is a very flexible source of finance. You could use it for short or long-term purposes, and it's internal. It's coming from inside the business. We would use our retained profits for any purposes that we like, really, but perhaps the most efficient use of them is to invest in new capital, machinery that will be used, fixed assets that will be used to generate revenue for the business in the long run. Things that are going to secure the business's long-term future. So the advantages are it's quickly and easily accessible. There shouldn't be any restrictions on usage. It's not like you've got it from a bank or from some new shareholders who are telling you what to do with it. So you can do what you want with it. There's no interest or dividend payment, and it's therefore a cheap option. And there's no loss of control as would come from selling shares and getting new owners involved in the business. So it's a great source of finance if you've got it available. Disadvantage of using it: if you want to keep a lot of your profits to reinvest in the business, well, your shareholders might not be entirely happy with that, particularly if they're after short-term gains. Keeping money to reinvest in the business may not be what they want to do with it. There's an opportunity cost of investing it. If you invest in market research, then you can't invest in a new factory, but you do get to choose what to do with it, so you would weigh up the benefits of each option. I guess another disadvantage that I haven't put there is that retained profits usually, you usually wouldn't have enough to do whatever you like with them. Apple are an example of a company that have an awful lot of money hanging around, a huge amount of retained profit, but that is the exception rather than the rule. So a disadvantage, you could say, is there are often limited amounts of retained profit. So what do we do if we don't have enough retained profit? Well, one thing we could do is to raise share capital by selling shares in the business. So money invested by shareholders in return for a share of the profit and part ownership of the business, which gives them a say in how the business is run. They get one vote per share in important decisions that are made at the annual general meeting. So this is a long-term source of finance, and it's coming from outside the business. Typically, we would use shareholder investment to fund investment and growth, so we earn those shareholders' returns in the future. What are the advantages of doing it? Well, if we're selling shares on the stock market, then it means that we're a public limited company and we've got limited liability to encourage potential investors. Getting shareholders to invest, earning money by selling shares, is good because yes, they're entitled to a share of the profit, but we're not legally obliged to pay them any dividends. We don't have to. If the business isn't performing particularly well, have a lot of money to give shareholders, well, they might ask for it, but we don't have to give it to them. Or we can just decide to reinvest any profits into the business. We may benefit from additional expertise if the people buying shares in a business are experienced in our industry. The investment is permanent, it doesn't need to be repaid. So when you talk about selling shares, they're not selling them back to the company. It's being sold on a secondary market, the stock exchange, to a new investor. The company's not involved other than to make a note of who the new shareholder is so they can pay them their dividend. Having PLC, which is public limited company, the title that is given to companies that sell their shares in the stock market, can improve brand image and actually make it easier to raise loan capital as well. There's a certain amount of prestige. There's a certain amount of also legal regulations, legal obligations that a PLC needs to go through, which means that it is likely to be at least relatively well managed, and its accounts are going to be audited, which creates confidence in banks to lend money. However, this will create a pressure to pay dividends. If we've got shareholders, people who buy shares might be focused on short-term gains rather than long-term benefits to the business, i.e. they want big dividend payments this year, which reduces the amount of money the business has to reinvest. And finally, the original owners will have a loss of control because the new shareholders will have a vote in how the company's run. Okay, last two that we need to do. First one is loans. So we would usually get a loan from a bank. This is money that needs to be repaid with interest, and usually we would borrow a loan for a specific purpose, like purchasing a specific piece of equipment, and we would pay it back over 3 to 5 years. A mortgage is a long-term loan that's used to purchase property. It's secured against the value of the property, and it will probably be often repaid over 25 to 30 years. Sometimes organising, depending on the loan, but sometimes organising the loan can be relatively quick and easy to secure, certainly much quicker than going through the process of listing the company on the stock market. It's far easier than that, although I'm not saying that arranging a loan is always easy. The loan is specific to the business needs, i.e. we ask the bank for £10,000 to buy a particular piece of machinery and to pay it back over 3 years. That would be a loan that's exactly suited to our needs. The fixed repayment schedule improves our budgeting. So, when we agree a 3-year loan, loan for £10,000, they add their interest rate, they divide that up over the 36 months of the 3 years, and it tells them how much money we're going to pay back, and tells us, more importantly, how much money we need to pay back, which helps our budgeting. Also, as compared to buying shares, we don't experience any loss of ownership. So we owe the bank the money, we need to pay it back, but we don't have to share our profits. We don't have to give the bank voting rights or decisions in how the business is run. So that's really good. However, the repayment terms can be fairly inflexible, i.e. okay, we agree to pay back this much every month, but what happens if we don't make a profit, or what happens if the market changes? Well, banks want their money back and they don't particularly want to be flexible, whereas if we've sold shares, we don't need to pay them a dividend, so we could reduce our outgoings in that way. Obviously the bank will come with the loan comes with interest, and we may need to secure a loan against the business's assets. So for example, securing the mortgage against the value of the property, i.e. if we can't pay the money to the bank would then take that property back. Okay, last one, venture capital. Venture capital is money invested into one business by another business, and that business that borrows the money would usually be considered quite high risk. So venture capitalists are businesses that specialise in funding usually small to medium-sized businesses experiencing rapid growth, sometimes quite high risk, and maybe these are businesses that struggle to get money elsewhere. So venture capital is an interesting source of finance because it's kind of like taking on a shareholder, because they would often take a portion of the company, but they would also, be more hands-on in the running of it than normal shareholders. They would offer advice, contacts, etc. To the growing business. Often they are specialists in the areas that they're investing in. So if you think about Dragon's Den, these are usually, that's kind of a model of what venture capital is. So the advantages of venture capital, so it's really good if for companies that can't find investment from other sources, particularly if that's because the other sources think they're too high risk. They get advice and support and contacts from experienced business managers within their field, and often there will be flexibility in dividend or interest repayments. The venture capitalists want this business to succeed. They're not going to, if things aren't going so well for a short period of time, they're not going to force them to repay loans, dividends. They can be quite flexible. However, we're going to lose some ownership. There's the potential for these experienced business owners to come in and take control to a certain extent of the business, and it also might be quite difficult to secure this investment. You need to go out to impress them, know your stats inside out, etc. You need to persuade them to work with you, and that might be difficult, particularly if you're a high-risk business who hasn't been able to secure money from elsewhere. So you've got, we've covered now all of those sources of finance that you need to. Final little bit. The sources of finance that are most appropriate depend on, number one, the use of finance. Is it long or is it short term? There's no point in organising an overdraft for buying an expensive new piece of equipment. A bank loan would be far more suited for that, because that piece of equipment is going to be in the business, is going to pay back the bank loan over a long period of time. Equally, getting out a bank loan for a problem that's expected to be, a cash flow problem that's expected to be solved within a few months. The bank loan's paid back over 3 years. If you potentially pay it back after a few months, why get a bank loan? An overdraft is far more suitable. So you've got to think about, what do we want the finance for? The amount required will be important. How much are we looking to borrow? Do we have enough within us? And to use our retained profits, or will we need to go outside? The level of perceived risk of the investment will be important. Can we get it from an ordinary bank, or do we need to approach a venture capitalist? The business's level of gearing, its debt as a proportion of long-term funding. I mentioned this in one of the earlier videos in the unit. If a business has already borrowed a lot of money, if over 50% of the money invested in the business is borrowed, it's going to have difficulty persuading a bank it should borrow more money. If a business hasn't already got a bank loan, that might, it might be far easier to organise a bank loan if the business doesn't have a lot of debt already, and we call that gearing, the amount of business, the amount of debt that has been used to fund the business. The legal structure of a company, if it is a private limited company, it won't be able to sell its shares on the stock market, so therefore that would prevent it from doing a share issue. The past financial performance and profitability has an impact, because if there are retained profits there, then why not use them? and that's usually the best source of finance. So that's source of finance. Questions will require you to analyse what are the advantages, what are the disadvantages of this source of finance, and what's best for this business given the use